Let us understand what a long position and short position in a futures contract. A long position in a futures contract means that the investor or the buyer would gain if the price of the underlying asset goes up. On the other hand, a short position is one under which the investor will profit if the price of the underlying asset goes down. Now let us see how a futures contract would work in real life. If a farmer thinks that the price of rice is going to fall by harvest time, he can sell a futures contract in rice. Here, the farmer can enter a trade by selling a futures contract in rice and then exit the trade later by buying it back. This way, if the cash price of rice falls by the harvest season, the money that he loses, he can make it good by gaining profit under the futures contract. There are two main types of futures traders: hedgers and speculators. A hedger is a producer of a commodity, example a farmer, an oil company, or a mining company who trades a futures contract to protect himself from future price changes in his product. Other hedgers of futures contracts include banks and insurance companies, as well as pension funds who use these futures contracts to hedge against any fluctuation in cash price of their products. Speculators are independent flow traders and private investors. Usually they don't have any connection with the cash commodity. They simply try to make a profit buying a futures contract they expect to raise in price, or sell a futures contract they expect to fall in price. In other words, they invest in futures in the same way they might invest in stocks and shares, by buying at a lower price and selling at a higher price, and the other way around. Let us now discuss the advantages of trading futures contract. Futures are highly leveraged instruments. To own a futures contract, an investor only needs to invest a small fraction of the value of the contract, what is we refer as margins. Usually it is up to 10% of, it's around the 10% mark of the futures contract of value of the underlying futures asset. In other words, the investor can trade a much larger amount of the commodity than if he bought it outright. So if he has predicted that the market movement correctly, his profits will be multiplied several times. This is an excellent return compared to buying a physical commodity like gold bars, coins, or mining stocks. Speculation with future contract is basically paper investments. You don't have to literally store 3 tons of gold in your garden, or 15,000 liters of orange juice in your driveway, or have 500 live hogs running around your back garden. The actual commodity being traded in the contract is only exchanged on a very rare occasions where delivery of the contract takes place. In the cases of a speculator, a future trade is purely a paper transaction, and the term contract is only used mainly because of the expiration date being similar to a contract. An investor can make money more quickly on a futures trade as well. Firstly, because he is trading with around 10 times as much of the commodity secured with his margin. And secondly, because futures markets tend to move more quickly than cash markets. Of course, an investor can also lose money more quickly if his judgment is incorrect, although losses can be minimized with stop loss orders. Another advantage of futures is that futures trading markets are usually fairer than other markets because it is harder to get inside information. The open outright trading pits with lots of men in yellow jackets waving their hands in the air shouting buy, buy or sell, sell offers a very public, efficient marketplace. Also, any official market reports are released at the end of a trading session, so everyone has a chance to take them into account before trading begins again the following day. Next advantage is that futures markets are very liquid. There are a huge amount of contracts traded every day. This ensures that market orders can be placed very quickly as there are always buyers and sellers of a commodity. For this reason, it is unusual for futures prices to suddenly jump to a completely different level, especially on the nearer term contracts. Finally, in futures contract, the commission charges are very small compared to other investments such as equity and debt, and are also paid once the position ends.